SoFi is up 18% in the past month, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, SoFi is a fast-growing company that has grown revenues from $683 million in 2021 to $2.1 billion currently. In this regard, analysts are expecting them to reach $5 billion in 2028. They are a digital bank that works as a one-stop shop for financial needs. Their products are loved by their users, as in customer satisfaction scores, they are way ahead of the rest. As a result, they are seeing growth in their user base across all products. They announced their first profitable quarter in their last earnings with 2 cents per share, and they guided for 7 to 8 cents for 2024 and 55 to 80 cents per share in 2026, which is a 10x in their net income and would put them at a PEG ratio of 0.65. According to Peter Lynch, one of the best investors of all time, a PEG ratio of under 1 is one of the key indicators of finding an undervalued stock. Analysts only have them making 49 cents in 2028, but I believe they are going to beat this as they have beat every single quarter. And if they manage to reach 80 cents per share in 2026, and we assign a 20p to the company then, it would make it a $20 stock, meaning 122% returns in 2 years. Then, in order to calculate the intrinsic value of the company, I used my Excel spreadsheet, which tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These 3 numbers are the intrinsic value according to net income, and these 3 according to free cash flow. These numbers mean that in order to make the desired annual return that I have put in, which is 15%, you need to pay these prices. I went with 15% because you can get around 10% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. And because SoFi is a risky investment, we need more margin of safety than usual. The stock is currently trading at $9 per share. Therefore, if the low assumptions occur, you are going to make a 6.5% annual return on your money, middle 26%, and high 42%. For my revenue assumptions, I did 15% annual for my low, 20% on the middle, and 25% on the high, which is around what analysts are expecting. I assumed a profit margin and free cash flow margin of 10% on the low, 20% on the middle, and 30% on the high. This is the hard part about valuing SoFi, as there is no history of positive margins, but in their last earnings, they recorded a 7% net income margin, and their gross margin has been around 80% for the past years, so I think they can achieve this. I assigned a P and price to free cash flow of 20, 23, and 26, and I left the share outstanding change at 0%. However, they have been issuing shares, and if we consider that they issue 2% of their shares annually for the next 7 years, the valuation becomes less attractive. SoFi has a good balance sheet with $3.6 billion in cash and $5.3 billion in debt. The only risk that I have found in investing in SoFi is competition, as there are a lot of companies in the fintech industry. But I think their products are unique, and this industry is definitely going to grow in the upcoming years. In fact, it is expected to grow at a compounded annual growth rate of 17% for the next years. In conclusion, I believe investing in SoFi could result in fantastic returns, but it's a very risky play as it is a young company and it could get affected if we get into a recession. I hope you enjoyed the analysis. Let me know what you think about SoFi in the comments, and I'll see you in the next one.